Quick question. How is your current investing portfolio set up? Is it built for long-term wealth, just like Warren Buffett does? Or did you follow the hype headlines and build it full of AI companies? We are all seeing the AI bubble, and we're here to help you prepare. We created the anti-AI starter pack to help you bulletproof your portfolio for the inevitability of the AI bubble to burst. Today we're scanning 5 companies. We're doing McDonald's, Duolingo, Novo Nordisk, SHEL, and Berkshire Hathaway. Now these are not get-rich-quick stocks, but they will help you build long-term wealth, they will compound over time, and they will help you sleep soundly without having to worry about a bubble going to burst. Quick reminder, this is not buy or sell advice, we're just scanning these companies. If you want to get into them, do your own research. We're going to be scanning all of these companies by asking just 3 simple questions. Is it a great business? Can we reliably predict it for the future? And can we buy it for a great price? Now this is an extremely repeatable and easy to use process. And we've created Market Daddy to aid you in doing this. All you need is just 5 minutes per company, a phone, an iPad, or a laptop in your lab, and you're all set and good to go. Let's get into it. All right, let's start out with McDonald's, Mickey D's. Everybody knows what they're doing. I love their chicken nuggets, can't resist them. Let's say you don't understand or don't yet know what a business is doing. Right now we all understand McDonald's. You can use our due diligence. Here you will see what the company does and how they make their money in just one simple sentence. You will understand their competitive advantage, if there is any, their growth ability, their future expectations based on what management has told in their own earnings calls. It is all there for you to read. I'm not going through this right now, but if you're interested in it, you can go to our software and try it out yourself for free and read through the due diligence of any company, any stock you want. Now, when we look at our 3 basic questions, is this a great business? Can we reliably predict it for the future? And can we buy it at a great price? We can see that it's a pass for a great business. It's a pass for reliably predictable for the future, but it's a needs work for can we buy it for a great price? And I want to see if I agree with this, yes or no. And to do this, we'll be using our own valuation lab. Now, our own valuation lab already calculates the intrinsic value of any business if you consider what it did in the past relating to revenue growth and exit multiple, which is the multiple of the earnings of the company that you're currently paying, and your desired or required return on investment. Now, market average for required return is about 10%. Revenue growth based on the business record is about 9%, and its exit multiple currently is 25, which is significantly above market average. There is a reason though that McDonald's has a higher exit multiple, because it has such a strong brand name. This makes it very hard to compete, and therefore I would justify paying a higher multiple. Now, if we look at the current value based on the scenarios that are calculated here, it's currently worth only $270 while you're paying $315, which gives you an overvaluation of 15%. This makes it very hard to make a return on your investment. So McDonald's currently I think is too expensive. I would agree with the check that it needs work in relation to the price, but you can still put it at your watch list and see whenever it dips below $270 if it's a good investment or not. So let's add it to our watch list at 270 so we can keep an eye on it. All right, next up, let's look at Duolingo. Now, I love the app. My wife's French, I'm trying to learn French, and I use Duolingo. Now, everybody that I know that wants to learn a new language also uses Duolingo. And now you guys know that over here we're value investors. And Duolingo is not yet a value-based buy. It's more of a growth story. Our software seems to agree with this. It doesn't get any checks for being a great business, being reliably predictable for the future, or being viable for a great price. And I want to dive into it and see if there is still something here. And the reason why is because of their brand name. They are really, really well known, and it's really hard to find a better app. Whenever you talk about learning a new language, you talk about Duolingo. And they created a system that keeps everybody coming back. while delivering great value to their users. Now, I also see more and more people buying their premium subscription model. So they found a way to make money on people coming back. This is more of a growth story. And when you look at a growth story, you want to see growth and you want to see stable growth. Let's see if we can find that. And we're going to look at the graphs. Revenue growth, it's going up, very stable. Net income is going up. Free cash flow, it's going up. Operating cash flow is going up. Return on invested capital is going down. That's what we like to see change. But operating margin, increasing. Free cash flow margin, increasing. Cash to debt, very stable and still growth over a 5-year period. Debt to equity, growing. Shares outstanding, growing, even though you would like to see this decline. This is the odd one out. They're giving out more and more shares, diluting you as a shareholder. That's not what you want to see. But their book value per share is still going up, meaning that your per share value is still increasing. Now, if we take a quick look at their metrics, these are price metrics, these are not looking too good. If we look at their operating metrics, their gross margin is really, really high. This gives them a lot of cash to reinvest into the business. You can see their operating margin is not yet amazing. 10% for a software company can still be increased, but this will increase if they get more and more users and more paying users, and they have to spend less and less cash on growing and marketing the business. Their net margin is already at 12%, meaning they can keep a lot of the cash from what they make. I would like to see this increase, especially for a software company. Same with their EBITDA margin. But their gross margin positions them well to generate cash to reinvest into the business, and this will trickle down to all the other margins. That's what we want to see, and that's what we're already seeing when looking at the graphs. So I do not think it's a great business yet, but there's absolutely growth here. And how do we want to value this? That's where we'll use our valuation map. If we don't change anything and we just look at past business performance and we want a market average return, we can see that it's highly undervalued. But I don't think it's very likely that it will continue to grow for 40% in every scenario over the next 10 years. So let's change the numbers and see what we can come up with. Let's say for the best case, they do keep growing at 40%. Then I would be willing to pay an exit multiple of 25, and I always look for a 15% return. So we're going to use that across all 3 scenarios. Now for our base case, we're going to lower the growth. We're going to halve it by 20%. I'm still willing to pay an exit multiple of 20 for a company that shows 20% growth for a 10-year period, year on year. And for a downside, we want to say they can only grow by, let's say, 10%. We're going to pay about market average for this. An exit P of 15 for a 10% growth company seems about fine. We're going to run our valuation, and we can see that it's a little bit overvalued still. We come up with a valuation of around 120, while currently you're paying around $200. Now, since I'm still interested in the stock, I'm going to put it up. And I'm interested around $120. That's when I want to take a closer look at it and see at what price I actually want to buy it. And if we can see change, if there's still growth. So that's what I'm going to do. Now, let's take a look at the next stock, which is Novo Nordisk. We've talked about this extensively on our channel, so go watch our other video for more detail about Novo Nordisk and how it compares to Eli Lilly. But right now, I think Novo Nordisk is a great play. Sweden is very popular for investors and for a good reason. I think it's a great business that can be reliably predicted for the future, and I also think it can be bought for a great price, especially considering its growth. It's still growing. They're selling more and more obesity medication, and as more and more fat people will come to live in our world, which is sadly still the case, Novo Nordisk will profit. Now, if you want to dive into this yourself, go over to marketeddy.ai. You can play with all the numbers, look at the company yourself, and go watch our video, Novo Nordisk versus Eli Lilly. Next up, we want to be looking at SHEL. Now, we're contrarian value investors. And investing in oil right now, people love to hit oil stocks, is contrarian enough. The reason why we're still interested in it is because it's a huge cash flow machine, and SHEL especially is managing their cash flow and their balance sheet extremely well. They are very diligent, and therefore they have a lot of cash generating ability, and they manage to make sure that the cash ends up in your pocket as an investor. As a value investor, that's what you want to see. Now, there's also some risks in relation to SHEL. If we look at our 3 questions, it's not a great business, but it can be reliably predicted for the future and it can be bought for a great price. Now, why is it not a great business currently? Let's take a look at the due diligence and let's focus on the key insights. They are a strong global presence with a competitive edge. Investments in renewable energy could fuel future growth. Now here, of course, renewable energy is a big competitor for SHEL because they're mostly in oil and gas, and they need to invest in order to be able to prepare them for the future. And investments basically cost money, and they have still yet to see a return on investment in renewable energy. A second risk in relation to SHEL, or the biggest risk, is the oil price. Currently, it's sitting at a very low point for the oil price. I think that's a great thing because it's more likely for the oil price to go up from here than that it is to go down from here. And since SHEL has been managing their cash flow and their balance sheet extremely well, they can stick around at the current oil price, and if it moves up, they will move up exponentially, and you can easily make a return on investment. And it's completely unrelated to what's happening in the AI space. So as an anti-AI starter pack pick, this is a great one to add to your roster. Now, whether or not you want to invest in SHEL, yes or no, you need to do more research. Go use our software. You can try it out for free for 7 days. No payment information needed, and you can cancel anytime. Now, our last company of today is Berkshire Hathaway. This is Warren Buffett's own business, although he's leaving it. Now, you can see that none of the checks are currently met. It's not qualified as a great business. It can't be reliably predicted for the future, and it can't be bought for a great price. The reason why I think it's still very interesting is because it's extremely boring. You know what it does. You know that it delivers. It's just slowly growing, returning value to investors. It's always a great pick for any portfolio. It's extremely safe. It's as risk-free as you can get when buying stocks. The reason why it's great as well is because Berkshire owns many different companies. And if you buy into Berkshire Hathaway, you're immediately very diversified within your portfolio. Now, currently, I would agree that it's not looking like the most amazing business because growth has been very limited. But I did the ability to reliably predict it for the future. I think it's absolutely a check there. It's extremely boring. You know what it does, and it will keep doing it forever. But it is it's a little bit valued a little high for what it's worth currently. So what I would do is I would add it to my watch list for about 400 and see where it goes from there. I would do more research if you're interested in this pick. It is not related to big AI booms and busts. It is doing its own thing. It has proven to be valuable over and over again. So if you want something that's safe and that counteracts or counterweighs all of the AI picks within your portfolio, Berkshire Hathaway is a great value pick. So here's the anti-AI starter pack. We have McDonald's for predictable demand and a global habit. We have Duolingo for a scalable moat and still a growth business. Then we have Novo Nordisk for their durable healthcare demand and a growth factor still attached to it. Then we have SHEL that still operates in a real world economy, generates really good cash flows and has a really well managed balance sheet. And then we have Berkshire Hathaway, which is a boring, slow, but still growing and compounding business worth owning and worth protecting your portfolio with against the AI hype. Now, all of the AI companies are hot right now, but these 5 companies are actually worth owning. Now, if you want to look at any company yourself, you can go over to marketdaddy.ai. You can try out our software for free, no payment information needed, and you can cancel anytime. Be sure to like and subscribe to our channel, and we'll see you in the next one.